All right, here we go. So I said I would talk about WeWork. I'm going to talk about WeWork. In the comments for this week's case study, you're going to see a case study I did on WeWork way back when. And that was before things got kind of funky, so there was a little part of me that was a little bit, not bullish, but a little bit optimistic of what I thought they could be. And we're going to put that case study in the comments. However, what I'm going to take you through today is a rather bloody ending. And so here we go with WeWork, which a lot of people are joking, as in we won't, as in won't exist very much longer, because there's talk of a corporate bankruptcy turning this into a disastrous commercial real estate smoking crater. But let me first take you through it. Once upon a time, we have founders and CEOs. So these two guys, they look happy, don't they? Miguel McKelvey on the left here and Adam Neumann on the right. Adam Neumann would become famous for drinking tequila at work, treating people really badly, buying a Gulfstream 650 with investor money, and a variety of other things. I'm not going to go through all of them, but suffice to say, if you go back and look, that was a Silicon Valley guy, born in Israel, not from Silicon Valley, but partying and doing exactly what the worst of Silicon Valley unsupervised CEOs would do, which led to his ouster. And for a time, we have this gentleman, Sandeep Mathrani. And as you can see, a little bit older, looks a little bit more cooperative and far more well-behaved. That led to recently, he has stepped out, and right here in 2003, David Tolley has stepped in as an interim CEO. So that's the leadership. We go from boys with an idea to take office buildings and rent parts of it to you and me. WeWork, sort of a Regus. If you've ever been to Regus, you could rent office space, make it cooler, make it nicer. They go and they do their thing. Adam raises billions and billions of dollars, behaves badly, gets tossed out. He becomes CEO, and then we're here. So let's look at the quick history of all that. Put a little structure around what I just said. It all starts in 2010, founded in Soho, which is part of Manhattan, New York, a little neighborhood down there. Then we're going to skip these 8 years of raising money and expanding and all these things that were going on to August of 2019, when the fund started. This thing was a darling. This thing was raising money from SoftBank and others, billions of dollars. They had raised, at this time, by the time this happened, I think they had raised close to $15 billion the startup had raised at the time they filed the S1. Now, what is the S1? The S1 is a document that you put everything in by law, and it says, I'm going public, and here's the story. Like going to a doctor and getting x-rays, scans, blood work, urinalysis, everything, and handing that to your fiance's family to review your entire body. That's really kind of what happens with an S1. You have to disclose everything. And if you look at it that way, do you smoke? Do you not smoke? Do you work out? What do you spend on yourself? But everything is in there by law, because if it's not, later, the SEC can come after you. Well, there was so much in there that a lot of people started looking at so much that was in there and saying, wait a minute, what's going on? There's some things in here that don't make sense. How is Adam Neumann renting places to himself? How does he, the owner of things that he's actually renting and turning them into WeWorks? What is up with that? And what is up with co-signing on a $500 million of debt line for him personally? Stop. We don't like it. So guess what happens? Firestorm, and they withdraw. Okay, S1, we're withdrawing it on September 17th. That 30 days, if you want to go look at it, if you're an investor, it's one of the worst 30 days of headlines in history. And if you were like me, you're looking at it and just shaking your head for a month saying, I can't believe there's something else. I can't believe there's something else. Oh, there's something else. For 30 days until they finally said, stop, we're pulling it back. Maybe we'll go public toward the end of the year. Yeah, right, you will. Then all that happens, all that scrutiny, everybody goes, not only should you not go public, this guy should be gone. Neumann leaves the company. He stayed on kind of as a consultant, but he was out off the board and a bunch of other things that happened there. He's out. SoftBank, that had invested, they look at it and everybody sees a smoking crater forming, and SoftBank writes down. Writes down means they wrote down the value of $9 billion of their investment on November 6th. Look at this. That's not even 2 months from here's our S1, we're going public, celebration, big dinners, expensive bottles of wine. Boom, SoftBank's writing it down. Then in 2020, all of this is, they're not going public, they're trying to dance, they're trying to get it. Adult comes in, Sandeep, to be CEO. Well, what do? They look around, they say, we still got to go out because if we go public somehow, we can make some money. They go out in a SPAC, $9 billion SPAC, after now the total financing and debt had now crossed $20 billion. There they have it. And then today, Tali is the interim CEO, and they're closing locations. They announced all of the square footage that was in Irvine. I think 70% of all their square footage that's WeWork in Irvine, California, which is Orange County, around the corner from Disneyland, has been closed. And now their market cap, meaning their value, is under $300 million. And they announced a 40-to-1 stock split on the edge of bankruptcy. That's the headline this week. I'm going to dive into that because that's what you wanted. Many of you sent me questions that said, hey, do WeWork? What's a 40-to-1 stock split? And why would they do that on one hand? I see that in the headline. And on another headline that says they're about to go bankrupt. Well, guess what? Here it is. This right here was when they went out and they went public on the SPAC. And they went out and they were okay, doing okay. Boom. That's, by the way, ladies and gentlemen, that's 14 cents. The stock is trading at 14 cents. 14 cents, a dime and less than a nickel. That's where it's trading now, and the market cap is at $285 million, which means the implied value of this company right now is $285 million after a multi-billion-dollar valuation. So what does a stock split do? If your stock is trading at $1,000, sometimes you do a 4-to-1 split to make it $250. So it's more affordable on a per share basis. That's very common. Amazon's done a lot of stock splits. A lot of companies do. Trading at $250, you do a 5-for-1 split. Now it's trading at $50. More shares can spin around and it's more affordable on a per share basis. A reverse split is where you take 40 shares off the market and put one back out worth the 40. Well, 40 times 14 cents a share is something around $5. So 40 shares go off the market, one share stays, and now it's worth $5. Why is that important? I'll tell you why. If you fail to maintain a minimum price, that is bad because you will get delisted. And this is on the New York Stock Exchange, and the New York Stock Exchange is talking about delisting the company. Well, if you delist the company on the stock exchange, you can't sell more stock in the future, which is one way that companies raise money. Especially if you're losing money, the way WeWork is, you may need to use the public market as a way to raise money, if you can. But nonetheless, the option goes away if you're delisted. And it's very tough to get back to being public if you're delisted. It's not just flipping a switch back and forth. There's a big review that has to happen. Wait, your stock was so inexpensive because your earnings or a controversy or something came up was so bad that the implied value based on the buyers and sellers, what they're willing to pay for your stock was so low, they're like, no, you're gone. So what do? You take the current price of 13 cents, 14 cents, 40-to-1, there's the 520. Now you're above the $1 you have to stay on, but it's artificial. It's artificial. All you've done is artificially created value by reducing the number of shares. It doesn't change the underlying company. You may still be radioactive to key partners, sponsors, it's people that would help you on the stock market, and whomever. That's the problem with WeWork. If they can't find profitable business in the middle of this, then this reverse stock split just basically delays the inevitable. So what are the headwinds? Headwinds is the wind against you. What is the wind against them? Well, part of the headwinds is themselves and what they've done, but also what's happened in commercial real estate. Work from home. You've heard everybody talk, and you've heard Pat and I talk on the PBD podcast about commercial real estate being readily available everywhere, and small banks maybe even trying to unload bad mortgages, and the price for commercial real estate down. San Francisco and its own problems with public policy, having tremendous vacancy. Well, guess what that does? That means WeWork has also got tremendous vacancy because the work from home and the commercial real estate market hurts them too. So the demand is down. That's a tough time for them to build revenue. And then return to office has turned out to be more of a headline than a reality. Some are coming back, many big companies are back, but overall we're seeing down in the big cities on commercial real estate. And now commercial real estate is a little bit radioactive for those small banks. So that's pushing on WeWork. And then finally, WeWork's board is finally clear-eyed about the inevitable. And this week they said there are, quote unquote, significant doubts about the company's viability going forward. And that, my friend, is the story behind one headline that says 40-to-1 reverse split and one headline that says pending bankruptcy. Both of those things are true. They're trying to stay on the stock market and they're desperately trying to find revenue, but they will never be able to issue more shares or use the stock market as a place to raise funds if they're delisted. And they're trying to stay on. But in the middle of it, they now have an interim CEO, that one CEO that stepped in and replaced Adam Newman. You know, he had his time, they thanked him, they said nice things to him, but either he was burnt out or couldn't get it or didn't turn it around all the way, and now they have another person stepping off the board into the CEO role on an interim basis. And that, my friend, is what's going on with WeWork. This high-flying fintech company, real estate tech, whatever you wanted to call them, has turned out to be a little bit of a disaster. And where they are right now, they're probably going to go bankruptcy, and then there'll be a sell-off. Money will be made to help pay off certain debts. But at the end of the day, I think this company is probably done. And they may do 3 bankruptcies in a row for the next 3 years, but I think it's just going to, delay the inevitable. At the end of the day, I think this is one of the casualties of what will be seen as a broader commercial real estate bubble bursting. But what's bursting more was an ill-fated startup that had its high-flying moment, and then from losing its IPO opportunity to losing its CEO and losing the trust of so many people in less than 60 days to where they are now on the edge of bankruptcy and just trying to stave off delisting. And that is the ugly story of WeWork.